I think it's very hard to come up with a persuasive case that equities will, over the next 17 years, perform anything like they've performed in the past 17.
Warren Buffett wrote this in 1999. He correctly predicted that the stock market, which had been rising at an astounding rate, wouldn't increase much for a very long time, a measly 2.5% annual return for 17 years. But the most interesting part is that the factors Buffett pointed to as predictors of weak future stock returns are once again screaming out at us today. And coincidentally, or maybe not, Buffett has been selling a lot of stock in 2024. He's sitting on the highest allocation of cash that he's ever had. So if the stock market was to crash like it did shortly after his Fortune article, then he certainly has plenty of cash to deploy. Okay, let's start by looking at what happened between 1965 and 1982. Looking at a 17-year period from 59 years ago might seem a little random, but it'll make sense in a moment. The S&P 500 rose from 85 points to just 141 points. A 66% gain. That's already a very weak return, but it's actually much worse than that. Inflation during the 70s and early 80s was extremely high. The prices of goods and services almost tripled between 1965 and 1982. So we could imagine a person investing $10,000 in the stock market in 1965. By 1982, it would be worth around $16,600. But the goods and services that you could have bought with $10,000 in 1965 now costs about $30,000. So once you take into account inflation, your real wealth during this 17-year period actually declined by 50%. And that's not even the crazy part. You'd think something like this could only happen if the economy performed really poorly during this period. It didn't. US GDP grew from $697 billion to $3.4 trillion, an almost 400% increase. And corporate profits increased almost 300%. This is the first case study Warren Buffett presents in his Fortune article. He points to the Dow Jones Industrial Average, another stock market index, which was practically flat from 1965 to 1982. During that same 17 years, the GDP of the US, that is, the business being done in the country, almost quintupled. If we look at another measure, the sales of the Fortune 500 more than sextupled. And yet the Dow went exactly nowhere. This period of time is a fantastic example of how the stock market can become disconnected from the true value of the businesses within it. If investors become too optimistic, they bid up stock prices too fast. Buffett examines the two important variables that explain why stock returns were so weak for such a long period of time. And those two variables largely explain where the market is today and what we might expect in the future. A quick reminder, if you haven't subscribed for free to the channel yet, we're almost at 200,000 subscribers, so if you'd like to see my videos on your homepage every now and then, consider hitting subscribe. The first is interest rates. These act on financial valuations the way gravity acts on matter. The higher the rate, the greater the downward pull. All investment opportunities, whether it's stocks, bonds, property, are compared relative to each other. You're thinking about how much cash the asset can deliver to you in the future, and because nobody knows what the future holds, you're also making an assessment about the likelihood of those cash flows coming to you, or in other words, the risk associated with those cash flows. And at the safest end of all the possible investments are US government bonds. The cash flows that you receive from a US government bond are practically risk-free. The bond tells you exactly how much it will pay, and the US government has never failed to pay out a bondholder. So US bonds act as a sort of benchmark to all other investments. If you can get a 3% risk-free or near risk-free return from a government bond, then at the very, very least, you would demand a 3% return from a stock. And as that risk-free rate goes up or down, so does the return investors demand on stocks. In the case of the 1965 to 1982 period, interest rates rose from 4.3% to 8.9%. The return you could earn risk-free from buying a government bond went up substantially. So investors required higher returns on stocks, or in other words, they were willing to pay a smaller price or a lower price relative to their profits, which undoubtedly contributed to the weak stock market performance during those years. In the second case study that Buffett presents, we see the exact opposite. From 1982 to 1999, the next 17-year period, interest rates fell from 8.9% to 5.3%, and the S&P 500 rose from 141 points to 1,469 points, a 942% increase. During this period, there was also considerable inflation, but even after adjusting for that, the stock market went up more than sixfold. The increase in equity values since 1981 beats anything you can find in history. This increase even surpasses what you would have realized if you bought stocks in 1932 at the Depression bottom. Sharp changes in interest rates is obviously a very relevant factor today in 2024, but it's just the first variable that Buffett discusses. The second is corporate profits, which he looks at as a percentage of US GDP. In effect, what this chart tells you is what proportion of GDP ended up each year with the shareholders of American business. Of everything that the US is producing, how much of it is going to stock market investors? This comparison of corporate profits to GDP will become really important a little bit later when Buffett talks about how it is expected to change in the future. Corporate profits as a percentage of GDP has a huge effect on investor sentiment and therefore stock prices. In 1965, it was 6.5% and fell to a low of 3.5% in the early 80s. So not only were interest rates high, providing a strong risk-free alternative to stocks, profits from stocks had grown at a slower rate than the overall economy. And as is so typical, investors projected out into the future what they were seeing. That's their unshakable habit, looking in the rearview mirror instead of through the windshield. From 1982 to 1999, US GDP grew from $3.3 trillion to $9.9 trillion, a 191% increase, and corporate profits rose 243%. That growth is considerably slower than the previous 17 years. And yet, stock returns were significantly better. I've thrown a whole bunch of numbers at you in the last couple of minutes, so let me just do a quick summary. Buffett's point was that large swings in interest rates have a big impact on how the stock market performs. And performance is also impacted by whether corporate profits have been strong in the recent past, as investors tend to incorrectly expect the recent strong or weak profits to continue in the future. Which brings us to the prediction Buffett made in that 1999 article. A prediction that is valuable to us today because we can use his logic and apply it to today's data. In 1999, the stock market was booming, up almost tenfold since 1982. Most investors have rosy expectations. Even those who have invested for more than 20 years are expecting 12.9% per year returns. Buffett thought that it was very likely that stock market returns could be very weak for the next 17-year period, 1999 to 2016. Today, if an investor is to achieve juicy profits in the market over 10 years or 17 or 20, one or more of three things must happen. The first was that interest rates must fall further from the 6% level at the time, something Buffett thought was unlikely. The second was corporate profitability in relation to GDP must rise. At the time, corporate profits in the US totaled $591 billion, or about 6% of the $9.9 trillion GDP. That's just about where it's sat on average for most of history, as corporate profits over the very long term have risen at about a similar rate to nominal GDP. So if investors expect stocks to return 13% per year in an environment where interest rates don't go down, corporate profits must become a much larger percentage of GDP. That or GDP would have to rise at double digits, which is pretty unlikely for obvious reasons. Buffett wrote, "In my opinion, you have to be wildly optimistic to believe that corporate profits as a percentage of GDP can, for any sustained period, hold much above 6%. He gave two reasons for this. The first being competition. If there's a lot of different businesses competing in the US for that profit pie, then it's unlikely it can grow at a higher rate than GDP for a very long time. The other factor is public policy. If corporate investors in aggregate are going to eat an ever-growing portion of the American economic pie, some other groups would have to settle for a smaller portion. That would justifiably raise political problems, and in my view, a major reslicing of the pie just isn't going to happen. So what actually ended up happening after 1999? Well, on the interest rates point, Buffett was actually wrong. They did continue to decline, falling to practically 0% by 2016. But he was right about corporate profits. S&P 500 earnings doubled over the 17-year period, and so did nominal GDP. So the profits of companies in the S&P 500 remained about the same percentage of economic output. But even with profits doubling and a huge cut in interest rates as a tailwind, the stock market went nowhere. The S&P rose a total of 52%, but after adjusting for inflation, just a 6.3% total increase over 17 years. Stocks became so egregiously overvalued in the late 90s that even with interest rate cuts and strong corporate profits, the stock market didn't go up. In 1999, stock prices were about 30 times the earnings of companies. That contracted to 24 times earnings by 2016. Still higher than where it sits historically, but enough to make stock returns very weak for more than a decade. And this is really important today because once again, the price to earnings ratio of the S&P 500 is about 30. Just like in the past, strong corporate profits have made investors extremely optimistic about growth in the future. S&P 500 earnings have more than doubled since 2016, while nominal GDP has increased just 50%. Interest rates have also risen a lot since 2016, sitting around the same level they were in 1999. So I want to show you what might happen to stocks in the next decade if things play out in a similar way to how they did when Buffett wrote his Fortune article. Nominal GDP growth is expected to be about 4.5% per year, so if corporate profits rise about the same amount, S&P 500 earnings would reach about $312 per share in 10 years' time. If the price to earnings ratio contracted from 30 to 24, just like it did between 1999 and 2016, the S&P 500 would be at about 7,490 points. A very weak 10-year period and practically no return in real terms if inflation is about 2% per year. So one of the most important factors for stock returns over the next decade is whether the current price to earnings ratio of 30 times will contract back to historical norms. It contracted from 1999 to 2016 because sentiment around profit growth shifted. The S&P only grew earnings at the pace of GDP, while investors were expecting much more. Lower interest rates could provide a tailwind for stocks, but there's no guarantee it will prevent weak stock returns. And there's also just no guarantee that we will see lower interest rates. We could imagine another scenario where interest rates stay around this level, which they've averaged historically. Again, corporate profits rise at 4.5% per year in line with GDP, but this time the price to earnings ratio of the S&P contracts to 15. Its long-run average. In such a scenario, the S&P 500 would be under 4,700 points in 10 years, almost 20% below the current level. We can of course also consider a more optimistic scenario. If the price to earnings ratio of the S&P was to stay where it is right now at around 30, then stock returns would approximate the profit growth of the S&P 500 companies plus dividends. So to earn a 15% per year return like the market has in recent years, you'd need profits to rise at double digits. Of course, there's no way for us to know whether or not this will happen, but it would certainly be unusual from a historical perspective. And it would mean that corporate profits as a percentage of GDP are at a level that has never been seen before. And Buffett has his doubts about whether that's reasonable to expect. But even if it is the case that some variables suggest that stock returns may more likely than not be weaker than they have in the recent past, it shouldn't really change the way that you go about investing. It's a reminder that you should only allocate money into stocks that you're willing to forego over the long term. But assuming that you already know this, it's certainly paid to be invested during the ups and downs rather than trying to trade in and out of the market based on broad predictions. Buffett is heavily invested in cash at the moment, but that's because he invests in individual stocks, not the index. He decides whether to invest in individual companies based on their individual valuations, but you're not doing that if you're buying the index. You're just trying to invest consistently to mimic the return of the stock market. Buffett's third sentence of the 1999 article makes this clear. Though I will be talking about the level of the market, I will not be predicting its next moves. At Berkshire, we focus almost exclusively on the valuation of individual companies, looking only to a very limited extent at the valuation of the overall market. Even then, valuing the market has nothing to do with where it's going to go in the next week, month, or next year. Subscribe if you enjoyed the video and consider checking out one of these videos next.